Good day, everyone. You're welcome to this week's Business and Investment Tips program, a production of RCCG Christ Church Radio with Ayodeji Ebo, an investment professional. This week, the focus is on the implications of the U.S. Fed rate cut. Last week, the United States Federal Reserve Fed cut its benchmark interest rate by half a percentage point, 0.5% on Wednesday, and signaled more reductions would follow, launching its first easing cycle since the onset of the pandemic, March 2020. The U.S. Federal Reserve is the central bank of the United States that formulates and administers credit and monetary policy. This is the U.S. central bank's first rate cut in over 4 years, leaving the federal fund rate at 4.75% to 5.00% from 5.25% to 5.5%. The 0.5% cut is larger than the Fed's customary 0.25% and suggests that the U.S. central bank may be concerned about the prospects of the weakening economy after more than a year of holding rates at the highest level since 2001. The Fed last cut rates by over 0.25% when COVID-19 tore across the global economy in 2020. What are the implications? In the US, 1. Encourages borrowing and spending. A rate cut makes borrowing cheaper for both consumer and businesses. Lower interest rates mean lower monthly payments on loans, such as mortgages and business loans. This can stimulate consumer spending and business investments, fostering economic growth. However, increased demand could lead to higher prices, raising inflation risk. 2. Boost to equity markets. Lower rates generally lead to higher stock prices because borrowing becomes cheaper for companies, improving profitability. Additionally, with lower returns on safer assets like bonds, investors tend to shift towards equities, driving up stock prices. 3. Positive market sentiment. A rate cut can signal that the Fed is taking action to support the economy, which can boost investor confidence. 4. Lower profit margins. Financial institutions, particularly banks, may face reduced profit margins on loans as the difference between the interest they pay on deposits and the interest they earn on loans narrows. However, more borrowing due to lower rates can offset this to some extent. 5. Lower yield on bonds. A rate cut often leads to a decrease in the bond yields. Existing bonds with higher yields become more valuable, but newly issued bonds will offer lower interest rates. Conservative investors relying on fixed income securities may find it harder to generate returns, pushing them towards riskier assets. 6. Weaker US dollar. A rate cut typically leads to the depreciation of the US dollar because lower rates make US assets less attractive to foreign investors. This can benefit US exporters by making their goods cheaper abroad, but it may raise costs for US consumers by making imports more expensive. In the global markets, 1. Emerging markets. A weaker dollar often boosts emerging market economies as their debts are frequently denominated in US dollars. A weaker dollar lowers the cost of servicing these debts. It could also attract capital flows into higher yielding emerging markets as investors seek better returns. 2. Commodities prices. A weaker US dollar typically leads to higher prices for commodities such as oil and gold because these are priced in dollars globally. When the dollar falls, commodities become cheaper for buyers using other currencies, boosting demand and prices. In Nigeria, 1. Potential increase in FPIs. Lower interest rates in the US will prompt the search for higher returns, which could lead to a boost in foreign portfolio investors in emerging and frontier markets in Nigeria, where higher yields can be found in bonds and equities. This will boost liquidity in the Nigerian financial markets, increasing the FX inflow and stabilize the currency. 2. Potential strengthening of the naira. A weaker US dollar resulting from the rate cut could lead to a relative strengthening of the naira as foreign investors seek Nigerian assets, increasing demand for the local currency. 3. Rise in oil revenue. A weaker dollar often pushes oil prices higher in global markets since oil is priced in US dollars. As a major oil exporting country, Nigeria stands to benefit from higher oil prices, which could boost government revenues and improve its trade balance. However, this benefit depends on stable oil production levels. 4. Increase in remittances. A lower US interest rate may lead to more money being remitted by Nigerians into the diaspora as their borrowing costs fall. The inflow of remittances could help stabilize household consumption in Nigeria, which is crucial for poverty alleviation and local economies. This is also a good source of FX inflow for the CBN. 5. CBN policies on dollar access. A weaker dollar and increased capital inflows might allow the CBN to ease some of the foreign exchange restrictions, making it easier for Nigerian businesses to access dollars for imports and capital projects. This could improve the overall business environment. In summary, the rate cut is typically aimed at stimulating economic growth, but it has broad and varied impacts across financial markets, the global economy, and specific sectors. The US Fed's rate cut generally brings both opportunities and challenges to the Nigerian economy. Nigeria's policymakers must carefully manage these external shocks to promote sustainable growth while avoiding fiscal or financial instability. Thank you for listening. Please join us same time next week for another interesting and insightful session. For questions, comments, and feedback, kindly forward to ebo.ayodeji@gmail.com or send an SMS to 07082463747. Stay blessed.